When the world bets on consumers, Beijing is doubling down on factories. China is choosing industrial power over a quick pivot to household-led growth, even as a harder-edged rivalry with the United States raises the stakes for that gamble. China's choice, production first, even as promises to consumers persist. At this month's Communist Party plenum, Beijing mapped a 5-year blueprint that will again prioritize high-tech manufacturing and the upgrading of heavy industry. The kind of state-directed, supply-side push that built China's global clout. Planners will still pledge measures to lift household consumption and mend long-standing supply-demand imbalances. But analysts and officials alike expect those consumer-friendly promises to be limited in practice. The headline language on consumption will comfort markets. The money, levers, and policy focus will remain tilted toward producers. Why the tilt toward factories is back and hard to unwind. Two forces push Beijing toward production-first policies. First, industrial strength is viewed as essential to strategic competitiveness. In an era when great power rivalry increasingly revolves around semiconductors, advanced manufacturing, and critical minerals, factories are seen as the hard currency of national power. Second, redirecting state resources from industry to households would weaken Beijing's ability to protect and scale strategic sectors, a risky move while trade tensions and the threat of tariffs loom. In short, industrial policy serves both economic and geopolitical ends. The contradictions: reflation pledges versus structural constraints. China's growth model has long been skewed toward investment and exports. That pattern has produced notable successes, but also mounting problems. Factory gate deflation in several sectors, a deep property slump, municipal debt strains, industrial overcapacity, and record youth unemployment. Those contradictions mean Beijing can promise more social spending, childcare subsidies, incremental pension lifts, stronger social insurance rules, but the fiscal room for a decisive demand-side pivot is constrained by tight local finances and the state's appetite to keep backing industry. Analysts expect incremental welfare gains, but not a paradigmatic shift away from production-led priorities. What this means for the US-China rivalry and the world economy. By prioritizing high-tech manufacturing and domestic supply chains, China is reinforcing the very dynamics that complicate US-China relations. Strategic decoupling in critical technologies, trade frictions, and reciprocal industrial policies. That dynamic makes Western efforts to re-industrialize or protect sensitive supply chains more likely to stick, while also raising the probability that economic competition will be managed on a geopolitical, rather than purely commercial, footing. For other economies, including emerging markets and exporters of commodities and intermediate goods, China's steadfast industrial push will shape demand patterns, investment flows, and technology partnerships for the coming decade. Risks at home. Can production-first policies carry long-term growth? Relying on industry to drive growth risks, perpetuating the very imbalances that have slowed consumption and increased financial fragility. Overcapacity and debt overhangs can weigh on returns and crowd out private sector dynamism. Meanwhile, a generation that trained for service sector opportunities faces a tight job market if consumer-led employment does not materialize. Policymakers therefore face a painful balancing act: preserve manufacturing and strategic autonomy without allowing deflationary pressures and social strains to erode long-term growth prospects. The pragmatic path Beijing is likely to take: expect the 5-year plan to stress targeted support for high-end tech research, domestic supply chain resilience, and selective social measures that shore up consumption confidence without draining industrial budgets. In practice, this looks like enhanced R&D subsidies, an industrial policy for advanced sectors, modest increases in welfare spending, regulatory tweaks to stabilize housing and labor markets, and cautious fiscal moves at the local level. These steps can ease pressures, but they stop short of a wholesale reorientation toward a demand-driven model. Bottom line, strategic continuity, not a reset. China's policy signal is clear. The country will double down on the industrial strengths that underpin its geopolitical ambitions, while offering measured consumer-facing reforms to keep the economy functioning and social stability intact. That is a recipe for continued global industrial competition, and for policymakers and businesses everywhere to plan for a world in which China remains, emphatically, all about production. Settings: use appropriate media. Use a female clear American voice for the narrator. Use YouTube audio library only.